Good morning. As this year's chair of the New York Metropolitan Chapter of the Counselors of Real Estate, it's my pleasure to welcome all of you to the June edition of our ongoing series of real estate webinars. Hopefully you were able to join our April and May events, and I'm pleased to announce that next month's event has been set for Wednesday, July 22nd at 8:30 a.m. More details on that at the end of today's program. As I've said before, counselors of real estate are known for innovation and creative problem solving. We have a very big problem. The purpose of these webinars is to help us understand the size, shape, nature, and potential ramifications of this problem from as many vantage points as possible, and with frequent updates as new information becomes available, so that we can better assess the impact of the recent public health crisis, economic crisis, and social crisis on real estate, in order that we as counselors can become part of the solution as we advise our clients on their real estate interests. It's a lofty objective, to be sure, but with a deep base of expertise, experience, and ethics, our organization is uniquely capable of pursuing it meaningfully, and our speakers today are well positioned to help us do so. It's my pleasure to introduce the moderator of today's program. Jonathan Schein is Global Head of Business Development for Institutional Real Estate, Inc. He is responsible for leading business development efforts globally, while also serving as the Managing Director for the Americas business. He oversees revenue initiatives for Institutional Real Estate Americas, Institutional Real Estate Europe, Institutional Real Estate Asia Pacific, and Institutional Investing in Infrastructure. Having been an IREI participant for many years myself, I can attest personally to the very high quality events and publications his organization produces. Jonathan is a graduate of George Washington University and is a member of the Urban Land Institute, the International Council of Shopping Centers, and of course, the Counselors of Real Estate. Over to you, Jonathan.
Thank you very much for that kind introduction, Neil, and it's a wonderful, wonderful to be able to present this morning. So what I'd like to do, it's the seminar or the webinar is Profiles in Recovery, and that, you know, an allusion to John F. Kennedy's book, Profiles in Courage, which you certainly need to have today. I'd like to introduce our two panelists. First, Hugh Kelly, Special Advisor, Fordham Real Estate University, and Principal Hugh F. Kelly Real Estate Economics, and Bob White, Founder and President of Real Estate Capital Analytics. They're going to make some presentations, and then we're going to have a question and answer period, and we also encourage our audience, which is nearly 200 registrants this morning, to please provide us with questions as well. We hope to have an interactive morning, and I'll lead off with you.
Well, thanks, Jonathan. It's an honor to be part of this morning's discussion with Bob and with you, and I thank everybody who's come to participate over Zoom as well. I really hope our comments are helpful to you. They elicit ideas and questions from your own experience. This is the 8th recession I've experienced since entering the workforce as a college graduate in 1970. Every downturn has had its unique features, but every recession has the common challenges of economic contraction, painful unemployment, reduced real estate demand, and uncertainty, even fear about the future. For America and for New York in particular, each trough has had to be bridged. It's a serious question to consider. How do we avoid getting stuck in the trough? And how do we get to the other side? But as this photograph reminds us, the US economy, our great cities, and commercial real estate have been able to bridge the gap time and time again because of our economic resilience and because of the adaptability of the property sector to provide for our needs of places to live and to work. Now, the backdrop for our conversation today is the threefold dimension of the 2020 crisis: a public health crisis, unprecedented economic stress, and in the past month, an exacerbation of social strains that have been in the business and really in our society for much longer than that. We Americans, and New Yorkers in particular, are famously impatient. That makes the coronavirus a real challenge, since there's no quick fix. Much as we'd like to believe in a miracle cure, a first wave, a second wave, then we get a vaccine and it's all over, that's not in the cards. The epidemiologists are telling us that the virus will be requiring us to modify our behaviors, and change the way we do things, not just through next spring, but into 2020 at least. That's more of a challenge than you might even expect. Last year, only 40% of the people in the United States bothered to get the cheap, widely available flu vaccine that was available. You know, so we have a real challenge in even if we do get a vaccine by the end of this year, having adaptation over the course of time. So it's going to take a while before the combination of vaccine, antibodies, and herd immunities substantially halts the spread of this virus. The duration of the contagion, plus the lasting effects of changing, like social distancing, like living and working from home, and revising our approaches to the functional design of real estate, are going to persist long beyond the immediate emergency. Just the same way that the adaptations to 9/11, long lines at the TSA in airports, the need to present identification as you enter in an office building, understanding that buildings will receive your packages for you before passing them on, all in the name of security, were unimaginable before 9/11 and now have become to be accepted as normal. Some of our changes in recent months are going to follow the same path. Now, professional economists are still trying to cope with a level of economic disruption that goes far beyond the parameters of a conventional forecasting model. Paul Krugman, the Nobel Prize-winning economist who writes twice a week for the New York Times, has called this a medically induced coma for the economy. The only other such experience in the 8 recessions that I've been through was the recession of the early 1980s, when Paul Volcker, then at the head of the Federal Reserve, raised interest rates into the upper teens and 20s in order to wring inflation out of the economy. And that created a W-shaped recession, one in which we went down, had a bounce back from a very, very low bottom, and then a second downturn before we reached a point where we could have sustainable growth. And I think that that is the picture that's laying ahead of us. That sort of a shape is being embraced now by more and more economists, including those at Comerica Bank. The partial opening of the economy over the summer is going to create month-to-month and quarter-to-quarter improvement, but the real figures to be looking at are the year-over-year change, and that's going to remain discouraging for quite some time. And even at that, I think Comerica's projections, which I'm showing on the screen now, are overly optimistic. It's more likely, given the contraction in consumer confidence and the contraction in final demand in the economy, that when we come back, we're not going to be seeing the projected 100,000 jobs per month, which, remember, is only half of what we had during the last decade, but more like gains that are in the 50 to 75,000 monthly job gains for the balance of the 2020s, once we do get beyond this W period. So the implications for apartments and for office are really significant. What does it mean for rents? What are the implications for value? And therefore, what's the implications for debt service on these assets? The Great Recession, which many of us considered to be a once-in-a-generation contraction, has been eclipsed by the contraction that we've seen just now. This current crisis is deeper and more sudden, but still we can learn some lessons from the global financial crisis. This graph, which was put together by Jeff Fisher, also a counselor for NACRE, shows that the last time around, that apartments were the first of the of the property types to begin to turn around about 2 years after the onset of troubles, and were the first to regain their value, but only 5 years after the onset of the recession. Offices plunged more deeply and remained a laggard through most of it, but by the time we hit the 7-year mark, remember that's a long way away, offices not only had recovered, but had accelerated beyond retail and beyond hotels. So where do we stand now? I think we stand with industrials clearly having the advantage, apartments next in line for recovery in this recovery, and then offices reasserting themselves. The retail troubles and the hotel troubles have been widely discussed, and I think we're going to see that be a lingering difficulty for our economy. Very broad generalizations attract attention in the media, and they resonate with the public, but they tend to be myopic, letting the short term overshadow investment potential. We've read a lot about the delay in delinquency in apartment rents, for example. The National Multi-Housing Council has a rent tracker, which is publicly available and which you all should be looking at fairly closely. And it shows that in April and in May, by the end of the month, 95% of the rent that was due for the council's sample had in fact been collected. By mid-month, about 83 to 85% had been collected. So payment has been slow, but it has been coming. The council sample, though, is a fairly high quality sample of apartment assets. Class C buildings in the rental sector have been lagging a lot. And here in June, by the end of the first week or so, only about 73% of the rent had been collected. And while that should improve over the course of the month, really the impacts of unemployment have hit the lower income brackets much more severely than the white collar sector of the economy. And so that's going to be a continued issue for the collection of rents, and therefore for the cash flow on the ability on the apartments and their ability to service their mortgages. In the short run, I think we should expect some continued pressure because of this eviction moratoria for households that were already heavily rent burdened before the pandemic. The prospect for incremental employment gain, though, as we go through the balance of this year, should ease some of that distress. One of the lessons of the Great Recession was that forbearance, even if it was laughed at as being pretend and extend or kick the can down the road, turned out to be a smart strategy for lenders, and turned out to be a smart strategy for equity as well. As I say, we're very impatient as Americans and as New Yorkers, but here's an instance where patience truly played off. So that means for financial institutions that workout activity and workout staffs is going to be important. We're going to be looking for cities with high volumes of market rate apartment housing in the upper income areas to get through this pretty well. That means places like New York and San Francisco and Boston and even some of the Sunbelt cities. I think garden apartments, especially those with larger units, could prove a very, very attractive investment opportunity because of their lower overall densities in a contagion-wary period, but also because they provide the ability for expanding and making more permanent a work-at-home kind of living, working arrangement. Not all white-collar rental markets equally get affected, though. And so I think that particularly cities that have strong technology base, and if you look at the NASDAQ, you see how that has been outperforming the broader based indexes, have a particular advantage. You know, so Silicon Valley, you think of in the first instance, places like Austin and Denver and Seattle. But remember that New York and Boston are now tech hubs, and we should be thinking about technology as a strength to these markets as well. Richard Florida's Creative Class books and my own research on 24-hour cities suggests that attractiveness to young people is at the heart of urban vitality. Attracting people at the start of their careers, where they can begin to move up the ladder, is an important distinguishing feature of vibrant cities. And I measure success as total cumulative returns on investment using NACREIF, and the 24-hour cities have had a substantial premium in attracting capital because they provide those higher returns. One reason particularly germane to the apartment sector is that capital shifts in a flight to quality mode during uncertain times. And America's major cities have proven to sustain investment liquidity when capital flows compress, as they have especially during recessions. So a sudden dislocation in the labor market gives way to a slow correction, and then corporate America's focus on talent is needed to return those employers to market competitiveness. And that, again, advantages the cities that are in the two left-hand columns in this particular graph. And it may spread to the 5 or 6 markets that are in the right-hand column as well. Remember, when we're thinking about young renters, that it is Gen Z that we're talking about now, not the millennials. Gen Z is a generation that has never known a world without the internet. They're avid for experiences, they're eager for independence, they're environmentally conscious, and they're politically and socially aware. Rental units in metros that are supportive of the characteristics of talent, technology, and tolerance have great appeal for Gen Z, and I think will be supportive in the post-COVID era. The office workplace requires a different set of functional challenges. On the positive side, unlike apartments, office buildings have cash flows that have the advantage of gradual lease renewal turnovers. While I absolutely subscribe to the maxim that the stock market is not the economy, I recognize that the sharp rebound in the equities market does reflect the expectation of investors that U.S. public companies retain solid capital value and are likely to prove creditworthy as office tenants. If there's a tide of bankruptcy ahead, it's likely to hit small business the hardest. And if office net income feels the effect, that is the source of that slow bleed, which I think is more likely than an arterial bleed out in the cash flow. The increased reliance on co-working firms in many large markets is a cause of concern. And many have looked at New York as having the largest number of co-working spaces, and that's correct. But a look more deeply at the statistics tells us that San Francisco and Miami and Atlanta and Denver and Seattle each have 3 to 5 times the number of co-working spaces per 100,000 of population. So the density of those co-working spaces as a percentage of the whole office market is greater in those cities. And those spaces are vulnerable. They're vulnerable not just because of their density and their pricing structure, but because business credit review was never really a part of signing up members to use that space. The movement towards ever-increasing office densification has met its Waterloo, in my opinion. The psychology of cheek-to-jowl office design is undergoing a shock therapy at this point. Employers are not likely to force high densities on their workers for liability reasons and for simple human respect. And employees are not likely to tolerate crowded elevators anytime soon. So even for the vibrant creative class, the 24-hour city markets, I expect some renewed enthusiasm about the complementarity of cities and suburbs. This rebalancing actually has been going on for quite a while, as Bob's data actually has shown fairly clearly for the past 3 or 4 years. And it's going to accelerate in a post-COVID office economy. We're not seeing the death of the downtown, which has been proclaimed so often in the past and has been so often disproven. But it is, in my view, a revalidation of the original concept of the metropolitan statistical area. That is, looking at a core city and its surrounding areas as an integrated, cohesive network of businesses and workers. So that said, we're all going to have to get our minds around the time period after the W, when US GDP growth potential is only about 1.5 or 1.6% per year and job growth of 75,000 per month or less becomes the norm. So from the standpoint of people underwriting loans, doing development pro formas, pricing out acquisitions, all of that needs to be rethought on the basis of a demand curve that is really quite attenuated for this decade. The shocking parade of initial unemployment claims, which have gotten up to 46 million in the past 3 months, have evoked the joblessness of the 1930s as a standard of comparison. Right now, it looks like fears of a 20% plus unemployment rate will not come to pass. But we're still going to end this year with an unemployment rate that's higher than any unemployment rate that we've seen since the end of World War II. This is serious stuff for the economy and for the real estate business. It's important, I think, that we not ignore these dark statistics. That's willful delusion. But we shouldn't give in to the counsel of despair either way. Although people would like to get back to normal, the lessons of the past are that nostalgia for what went before is just not the right approach. We didn't get out of the Great Depression by seeking to go back to the Roaring 20s. We got out of the Great Depression because we were willing to take a hard look at the economy and a hard look at assets and begin to see that the way we finance them and that the way that we develop them and the way we energize the economy had to look to the future, not the past. So we need to look at our office spaces from the perspective of increased productivity by investment in our human capital. Productivity is the source of the profits that pay the rent in the first place. And for apartments, we need to be thinking of the affordability issue, not simply from the cost side, but also from the revenue side. The solution to housing affordability in the United States has to come with raising the level of incomes in the lower quintile of the population. That's the way you're going to be able to afford the cost of building new buildings and operating existing buildings. And lastly, we need, in both the apartment and the office sector, to take the health issues of the current crisis in a serious way. Green buildings and well buildings have become and should be the new standard for development and operation as we go forward. So I'll wrap up with that and turn the Zoom back over to my colleagues, and we'll look forward to your questions, which I see some are coming in. Thank you.
Thank you, Hugh. And now on to Bob White.
Well, thank you, Hugh. Thank you, Jonathan. And thank you, counselors, for having me part of this morning. I think it's important conversations to have, even though there are probably few solid answers. Paul, if you can flip to the first slide I have, I guess I just wanted to start with a back up and look at the investment markets and make a couple of points. One, the beginning of the year seems so long ago, but we actually entered 2020 on a very strong set of factors in many different accounts in the investment markets. There's a tremendous amount of capital, both debt and equity. There was, I think, a growing belief that interest rates were going to stay low. And I, was starting to think that we might see more cap rate compression this year. But there's definitely a strong sense of it. But, even before any of us had ever heard of COVID, the market had been moving fairly cautiously. Investors, and we've been talking about it, as an industry for several years now, what stage of the cycle we're in. It, used to be innings in baseball. And it was, we're in a doubleheader or we're, whatever that was. Then people just stopped talking and just, gave the consensus we're late stage in a cycle. And certainly that was true. When you look back at, volume and pricing trends, 2015 was, and I would say probably the end of 2015 started to feel like a frenzy in the market. That's when the Chinese investors were, the most active as well and setting, price records in a number of places. And then the market started backing off a little bit, 16, 17, 18, as we entered each of those years, the fear was that interest rates were going to spike and real estate prices were going to be negatively affected, So consequently, we weren't in a huge expansion phase in terms of development. Development was ongoing, but it wasn't out of control. There may be a few sectors and markets that were areas of concern, but, not on a macro basis. Prices were still rising, but at a slower pace. Investors in particular were backing off of the most expensive markets that they felt were, priced to perfection. Manhattan, we had actually started to see a little bit of weakness in San Francisco and San Jose, which was astounding. And, that was just basically a little bit of pushback, on the high pricing. And then, of course, COVID came along. So, my point is that even though we didn't know it was going to be COVID that was going to end this cycle, we knew that there was going to be something, and it was getting closer. And I think, for a long time, we thought it was going to be interest rates. And certainly now, and I was noting on Hugh's slide, the, projection, I think it was from, I forgot one of the banks, but the 10-year treasury at below 100 basis points, a year and a half out. So certainly nobody's projecting, sharp rises in interest rates now. So we're entering a very low interest rate environment. That is, we were in one going, before. And certainly real estate stands out as a good investment prospect in low interest rate environments. So, the fact is, we were expecting an end of the cycle, so people weren't, I guess the phrase is over their skis too much, or, there hadn't, people were being a little more judicious about taking risks than, if you remember at the height of the cycle leading up to the global financial crisis, people were just going 100 miles an hour until it ended. And that certainly wasn't the case here. As well as with that expectation that the cycle would end at some point in the near future, there was a lot of capital that was kept on the sidelines. It was being judiciously invested, but, an increasing number of our clients were saying that they were keeping dry powder. They were going to wait for some price correction or some weaknesses in the market that they can arbitrage. And so we are entering this, downturn with a lot more capital, both equity and debt, than we've seen as we've entered other down cycles. I mean, certainly going into the GFC, we saw lenders go belly up, and we were seeing, investors and developers, filing bankruptcy, quite rapidly. We're not seeing any of that. If anything, I'm hearing less about people that are, afraid for their existence, among real estate investors than those that are kind of licking their chops at the opportunity to buy stuff at a discount. So that should help get this correction or recovery underway a little faster than normally would have, because the capital is still there. I also think that, people have been, Hugh showed, and mentioned the stats on collections for multifamily. And I think outside of the retail sector and the hotel sector, people have been positively surprised that the collections haven't fallen as much as they have. Now, there's a question of, has PPP and some of the other programs kept that higher, but that's, yet to be told. So that was just, a little bit leading up to and the situation going into this cycle. Now, what's happened in the first couple of months of it. So Paul, if you can flip to the next slide. I have some stats for you that we just actually were publishing today, our May stats. You have the monthly volume bars upper right there. You can see, we started to see a little bit of effect in March, but it was really, April and May and continuing on in June that we've seen volume fall off the cliff. Overall across all property types, volume is down, was down 80% in May. Hotels, it was down 95%. I think there are less than a handful of hotels that traded last month. Retail is certainly suffering more than the others. Apartment and office, really haven't distinguished themselves better, but they are certainly, I think we are seeing a little bit more activity there. We did see a number of deals that were in contract, fail to close, but that spike in busted deals was not as significant as I think it could have been. And I think that a lot of the deals that were teed up going into March and April did end up closing. Some might have been retraded. We see a little bit of deal activity. And when we look into all that activity, we're trying to figure out, are there trends by market, certainly by property type, hotel and retail are suffering the most, and industrial the least. But no trends really by market yet. But one thing that, has been significant is that the smaller properties, say under 15, under 10 million, that segment of the market has slowed more considerably than the more institutional, larger side of the market, where we are still seeing some trades. But the market is, very much, in a period where, I guess the phrase catching a falling knife is, hurt a lot right now, because people aren't really sure where prices are going to settle out, and they don't want to necessarily be buying until they figure out where the floor, better idea of where the floor may be. Construction starts, and, the spring is, the most active time for people breaking ground on new projects. And that basically followed volume trends. It, literally collapsed 80, 90% decline starting in April and May in construction activity. And that's, exactly as you'd expect. As I mentioned before, we weren't in a terrible situation in terms of new supply. I think, unfortunately, people are a little bit worried about the senior housing and hotel sectors, which are, the two that'll be most affected by COVID going forward. Despite the continued construction, it was dominated by multifamily, that wasn't as big as a concern, except in a few places. One thing I will mention, just because I know there are a number of apartment investors, even though the construction starts may be declining, I would be careful. I'm hearing a lot from hotel investors that they're considering whether they were in the midst of developing a hotel project, or they own a number of hotel projects that are no longer viable. They're looking into converting those into multifamily, whether micro units or, some other multifamily rental product. So that could be a unanticipated, supply, even though construction starts are down in the apartment sector. One of the bright spots we've seen is just tracking refinancing activity, and it's off. It's off by about 30% collectively in April and May compared to earlier in the year. but that's not like the 80% decline in sales. In fact, actually refinance activity because of the agencies is actually up for apartments. But what's most significant about this is we're not in a severe credit crunch. What that indicates is there is still debt capital, there's still lenders out there, for the right deals. And certainly as loans come due, they're able to get refinanced, which was certainly not the situation we saw in the GFC. It's still too early for us to have seen many distressed sales. Distressed sales was only 3% of all activity last month. And it's really going to take distressed sellers, somebody that's forcing sales to happen for the trades to start showing a pricing correction. But it's really slow. But we'll see those. I mean, the reports of potentially troubled assets, which whether they're watch list in the CMBS world or otherwise, are skyrocketing, and other notices of default are also growing. They're not as large, but collectively, we're tracking about 125 billion of watch list and potentially troubled and troubled assets, mostly in the potentially troubled. Now that compares to about 470 billion of defaulted commercial mortgages we tracked at the height of the marketplace during the GFC, just as a comparison. Some of those could be cleared up very quickly once the rents could start flowing again for some of the office properties, or maybe they weren't even affected. But the hotel sector where, revenue to pay debt service is, looks like it's very far off in many cases, and some may not reopen, is going to be, a very tough area. I agree with Hugh, and we'll talk a little bit later on of, what some of the resolutions of this distress may be. Let's click one more slide. And I just want to address where property prices are. I mean, I think, a professor, and, theoretically, there's really no pricing level yet. We're in the midst of price discovery. And in fact, things like this webinar, and I've encouraged, and I'm glad to hear that the counselors is doing quite a few of these, and local chapters and national, because that's part of the price discovery process. People talking and getting consensus on what may or may not happen, and listening to other smart people and sharing ideas. We've never been a forecasting shop, but we been working with MIT Center for Real Estate for a long time, and we worked with them on analysis recently where they have been using our data to try to discern the difference between buyer and seller expectations. And that's what you're looking at in these orange lines here. And basically what's showing is that there's about a 12% gap in office, that buyers' pricing is about 12% below where sellers would want to sell. And that's why we've seen volume collapse that by 80%. Nothing's trading because there's that gap between buyers and sellers in that price discovery that needs to happen. There needs to be more motivation on the sellers, distressed sellers, to bring some of these prices down. Now this is, theoretical, but I think it makes sense. It kind of matches some other forecasts out there. At times like this, you got to look at a lot of data points. A lot of people are looking at the REIT market as benchmarks. You got to look at, everything, the stock market, global markets, everything, to try to get an idea. But it's showing office assets. The price gap right now is about 12%. It's a bit less for apartments, 8%, and actually not that significant, 6% in the industrial sector. So all that seems to match our guts, even though I can't explain the math behind this. If you go to the MIT Center for Real Estate, there's a paper that gives more background on this. It's actually on the platform for commercial property price dynamics that my company RCA sponsors. So if you do want to get into the weeds on that, that's where you can find it. And then finally, let me kind of give you a preview of what it looks like, I think, going forward based on last cycle, the last distress cycle. So Paul, if you could flip to the next slide, so this is what the cycle after Lehman fell looked like. The horizontal lines, I think I missed the x-axis, are the years after the shock. So, like the last cycle, this one started almost with a date. We can peg it to March of 2020 when the economy stopped. And last cycle, we can kind of peg to, when Lehman fell. And, and there was a period in which we're in right now. I call it the shock and triage period, about a 6 to 9 month period where we see huge distress inflows, defaults, notices of defaults, and properties added to watch list, and all of that happened. That's that blue, that's the monthly or quarterly flows of, inflows of distress. And then it was not until actually a full year after Lehman fell that we started to see, workouts happening in a meaningful way. And we're seeing that happen this time. Hugh mentioned the forbearance agreements. Lenders are being pretty generous with granting 90-day forbearance agreements. Those are starting to come due. They'll probably get another 90 days. And then by the end of the year, we're going to have to really start thinking about some longer term solutions potentially. But, I kind of agree with you. I think that the, extend and pretend, pray and delay worked well for the lenders last time. And it should work particularly well this time because, this was an unexpected event. The economy was doing well going into it. We could be having a V-shaped recovery, or, certainly if you look at the stock market. And so I think that could help a lot of assets, particularly for office and retail. Hotels could be very different. Retail is going to have more challenges as well. But office and apartments, I think we probably won't see as many things go through foreclosure. But it's going to take a period of price discovery, and that's going to take some time before we really know where prices end up settling and what kind of losses lenders are going to have to suffer, and how that's going to play out. All I know is it's definitely going to be very specific to each property type. It's going to be hard to draw an average. Once workouts start happening, it happens relatively fast. So kind of within, the last cycle of the GFC was about 4 years overall that it dominated the investment markets before it started clearing out. But really, it's in the first, 24 months that investors looking for those outsized returns make those returns. So if you're in the distressed space, you should certainly be gearing up because it moves very, very quickly. And so that's what a distress cycle looks like. I think many of us, and especially in the counselors, since we're all well experienced, forget that there's a generation or two of people that haven't ridden out one cycle, much less several, or 8, or in my case, professionally, 4. So with that, I will leave it and hopefully look forward to some robust Q&A. So back to you, Jonathan.
That's terrific. Thank you, Bob. Thank you, Hugh. Wow, there's a lot to unpack here. So I'd like to just reflect first on something that Hugh had brought up right from the beginning, that so much of this has to do with behavior and misbehaving. And we all forget that this country was founded on a bunch of guys that decided to actually make a document and misbehave. So that's our legacy. So it's a little difficult to change our behaviors as a society, but I think we'll get there, and we do ultimately adapt. But as this webinar is really based on New York City apartments and office, I'd like to kind of hone down to that. And based on Bob, your statistics of 80% decline in deal volume in April and May. Okay, that's devastating. And it's not like anybody ever says, I feel sorry for a real estate broker, but this has a devastating impact on the economy. So, and then we're talking about pricing. And so I have a question for you. We just got a press release that Notel just is being sued by one of its landlords because it decided it doesn't want to pay its rent. Are we going to go start seeing that kind of effect right now? Both Bob and Hugh, are we going to start seeing the trickle down of what the effects of the last few months are? People are finally saying, I'm not paying my house rent, I'm not paying my retail rent, I'm not paying my apartment rent, I'm not paying my industrial rent. When do we see that start to hit the market?
Well, I'd say that the fact that, this first instance came out of the hospitality sector is not a big surprise. And the graph that Jeff Fisher did about recovery out of the last recession indicated that hotels never really got back to 2007 and 2008 levels. Particularly here in New York, we've had such a explosion of new hotels, and New York, it should be remembered, is a market that depends not only on business travel, but upon 60 million tourists per year. And if you've been walking through Times Square recently, you've noticed lack of tourists. And that's going to continue to be the case because Broadway is shut down, at least to Labor Day, and probably beyond that. The Philharmonic, the Metropolitan Opera, Carnegie Hall have all canceled their fall season, so nothing on that front. I wouldn't be surprised to find the Rockettes on leave for the Christmas show. You know, so the hospitality sector dependent upon tourism is really something. Most of the New York apartment owners that I've spoken to over the course of the last 6 weeks have said that they're very happy with their collections. But again, that's not a full sample because the people that we're all familiar with in the apartment sector tend to have the market rate apartments that have folks who, even if they're not in residence, even if they've gone off to the Hamptons or to the Adirondacks to wait this out, are still paying their rent. The difficulty is the people who are leasing, who are Uber drivers or Lyft drivers, who work in kitchens and are in the restaurants. And I think those small apartment owners are going to be in the greatest distress. And I think they're going to have to work things out with their banks. The political pressure for a moratorium on evictions is going to stay present, and hopefully that's matched by some ability to relieve the landlords in terms of the debt obligations. But that needs to be worked out. One thing we know about the banks, of course, is once they take a loss on their balance sheets, that's going to show up in their stock price. So they're very reluctant to do that. There is plenty of reason, I think, as Bob has indicated, to think that forbearance. I love the phrase "pray and delay," Bob. Not part of my vocabulary, but it's fine. And so, yeah.
The only thing I'd add, Hugh, on that is because of the moratorium on kicking people out, and that's commercial and residential. I think that's going to really complicate the matters here, and that's likely to be extended. And then, does that become a defense against a default on a mortgage note? So there are a lot of legal questions. I think it might be an idea for counselors to get a New York real estate attorney involved next time, because this is kind of a whole new area right now.
Sure. So, we were actually talking about deal velocity values, and one of the things that did fall off the shelf last year was really the amount of foreign capital that came into the New York metropolitan area. Now, that was what helped the recovery last time. A lot of Asian capital, a lot of European capital. Do we see, based on, and I'm not going to get into politics and who, what, and why, but do we see that there will be a trepidation of foreign investors to come back into these markets?
Yes. But we had seen that even before COVID came along. The whole nationalism and trade wars, cross-border capital had declined measurably around the world, and particularly in the U.S. And it's still significant. We measure direct investment into assets, so reportedly the funds flowing into some of the private equity funds are a little bit stronger, and that's probably going to be the way foreign investors will play U.S. real estate over the near term, as opposed to buying directly, if only because you can't fly internationally right now, and I think that's something that's going to be one of the last things that goes, for investors. But, U.S. yields are still so attractive to foreign investors, and many also have been waiting for a bit of a price correction to enter the market. I've been astounded. Watching London and Paris, there's a whole rung of investors that have been sidelined waiting to get in, and now's their chance. So they're kind of keeping prices from falling too much in those markets. I think that.
Thank you. Hugh, a question for you as our economist regarding the Federal Reserve. They've basically given us a big guaranteed benefit, guaranteed income right now, but that's going to run out. Not just the Fed and the government, the federal government, the stimulus. When does the Federal Reserve, if the Federal Reserve, from one of the questions from our audience, when do they turn off the spigot, and what happens when they do?
The Fed has a dual mandate on employment and on monetary stability. And so I think those are the two things that they're going to look at. As long as we have unemployment that is in the double digits or even the high single digits, the Fed's inclination is going to be to err on the stimulative side. That means low interest rates and an ample supply of funds. On the inflationary side, right now in a crisis like this, the issue is not inflation at all; it's deflation, and that is a much more dangerous and harder to get out of dilemma. So I'm expecting that until and unless we begin to see some kind of upward pressure on inflation, that the Fed is going to remain accommodative. The one thing that I would say is the Fed has been doing this, in the last year at a time when fiscal policy had also been very accommodative. The tax cuts and the federal budget deficit were all ways in which the economy of the last 2 years got pumped up beyond really its long-term potential. So the real question for me is, what can we do on the fiscal side in the year or two ahead? Because the generosity in the trillions of dollars flowing from fiscal stimulus is probably not a sustainable flow.
Of course. Okay, thank you. Now, because this is Neil's party, I'd like to bring him back in and as our chapter chairman. But with that, I'm going to pose a question to all three of you. We keep talking about, and as you said, we're impatient people, Hugh. We keep talking about a recovery when we don't even quite know what the diagnosis is yet. So the question to all three of you is that, to use an analogy from an illness, there are illnesses that kill you, and there are other illnesses that you manage a process through and you live with. Hopefully, the three of you can give us some wisdom about managing the illness we're in right now versus falling off the cliff, because we don't know where we are, as Bob said, in any of this. So, Neil?
Well, in a portfolio I'm familiar with and have some level of asset management responsibility for, tenant retention has been everything through this, and it's largely a multifamily portfolio. So, in the spirit of Hugh's comments about forbearing or extending and pretending we're doing everything we possibly can to retain tenants that are struggling to pay their rents right now. That's our strategy for managing through that in that portfolio. I'm wondering myself about Hugh's comments on maybe a new balance between the urban areas and the suburban areas. And there's a question from our audience regarding CEOs, as the question asker puts it, vacationing in less dense places right now, liking it an awful lot. Their thoughts possibly turning to, hey, why don't I just live out here? And as an extension of that, why doesn't our business be out here? And I'm wondering to myself if this turns into a new dawn for suburban office space. If it's true that we're going to have to learn to live farther, go about our days, distance more from each other. Is this the moment when it becomes attractive to move a business into a low-rise suburban office building that's accessible by car, that has internal staircases, so most people don't need to use the elevator, and frankly, a more generous amount of space per employee historically?
So I think Bob's data has been showing that kind of spread of investment flows, not just to the garden apartment sector versus the mid to high rise sector over the last few years, but also to secondary cities, which tend to be more order dependent, and even to tertiary cities, particularly on the part of private equity, Bob, right? So I think yes, but my comment about it is not being too myopic about that, I think is also important, because as a CEO might want to bring those operations out to less dense places, they need to also consider what is the impact of that on their ability to attract new talent into their workforce. And for me, cities that and this is not a plug for Fordham, but I think it's true across the board, that cities that have solid cores of high-level research universities, Boston, New York, Chicago, among them, but you can go across San Francisco with Berkeley on one side and Stanford on down in the valley. That brings people into those metropolitan areas that tend to stay in those metropolitan areas, as opposed to a place like Pittsburgh that has a cadre of great universities, but educates people and then exports the talent to the major employment centers, because Pittsburgh is a less vibrant city than the ones I've mentioned.
I will say that I think everybody's learned that working from home is an alternative. It's actually, I've been astounded at how smooth the transition's been for our own firm. I mean, there are a lot of things that's tough. It'd be tough to grow and hire people like this, but it's made people a lot more agnostic about locations. I think that whether it is having satellite offices in, suburban locales or, secondary markets is a lot easier, might be, more easy to accomplish. But, I do think that it's going to be a long-term trend. It's going to play out. But I think, all of us on Zoom and learning to work from home is, something that's going to fundamentally change things for good and bad, and make office a little less location sensitive.
Great perspective.
Did Jonathan fall off?
I think we lost track of Jonathan.
Hopefully he'll be back. So Neil, do we have more questions?
We do. What about college towns? Just thinking about the near-term impact of, say, a Princeton or a New Haven or a State College, Pennsylvania, or an Ann Arbor, Michigan, that are so reliant economically on students arriving in the fall and doing all the economic things students do when they go back to college. How are they going to survive in the near term?
It's a complicated question, Neil. Not only is there the question of student dormitories and the need to have less dense dormitories, at least until the pandemic has run its course, but also the ancillary income that universities gain from renting spaces for meetings, for conferences. That's a lot of lost incomes for universities, and I think it's going to make this a very difficult year. Now, does that create some external demand? It probably does. I know that NYU's reopening for classes is a partial reopening, and their opening of the dormitories has been for single occupancy in the dorm rooms themselves, which cuts in half, at least in half, the number of students that can be accommodated, and therefore spills over a bit of demand into the rental apartment sector. So some of that could happen. Student housing, has been a growth industry. I think there's going to be, and Bob, you might comment on this, some skepticism about the profitability of student housing in the near term before it reasserts its longer term trend.
Well, it looks like we're up for time. I'm not sure what happened to Jonathan, but if you can still hear us, Jonathan, thank you very much for your moderation of today's session. And Hugh and Bob, thank you so much for your perspectives. For our participants, thank you for joining us. I know 8:30 is early even for us New Yorkers, and for those of you on the West Coast, it was 5:30 in the morning, and we very much appreciate your participation. I hope you can join us for our next event, which is set for Wednesday, July 22nd at 8:30 a.m. Victor Kalanog, one of our CREs, is going to present the post-COVID-19 CRE world theory and practice. And we'll be addressing issues like how has COVID-19 changed how we think about data analysis and forecasting. So please mark your calendar, watch for the invitation email, and we will see you next month.
Thank you, and thank you to everybody.